Welcome, everybody. No shortage of things to talk about going on around the world. As is our focus, I will try to keep my comments and the stories I share with you to stories that are related to economics, finance, and investing, so you can see how it will likely affect you and your retirement. So that said, if you have a question as we go through the material today, please go ahead and just type it in the chat box on the right-hand side of the screen. I'll be monitoring that as we go through the material today. So that said, let's go ahead and jump in. Is inflation now turning to hyperinflation? I've got some statistics that were shared with me this past week by Dr. Bob McHugh. Also, there's talk about a policy response now that, in my view, and from studying history, would be disastrous as it relates to responding to inflation. About a month ago, I warned about it, and now there is actually talk going on that this may be the policy that is pursued. David Stockman, former budget director, had some comments on the Fed and the national debt. Very telling comments and very spot on comments, in my opinion. And the evidence is building that we are now in a recession, that we are seeing the growth in the economy stagnate. And I'll give you some evidence on that as well. So again, as we go through the material today, go ahead and type your questions in the chat box on the right-hand side of the screen. So a diner in Pennsylvania that Dr. Robert McHugh is familiar with. He actually lives in Pennsylvania. For those of you that are not familiar with Dr. McHugh's work, he has the website Technical Indicator Index. He is a very, very hardworking market analyst, also comments on what's going on in the economy. And when you look at restaurant supplies, this is from a Facebook post from a diner in Pennsylvania. Fryer oil prices, $21 12 months ago, $35 6 months ago, $45 today. Chicken wings, $45 a case 12 months ago, $175 a case today. Takeout boxes, $25 for a case 12 months ago, $95 today. Now, if you look at the percentage increases in 1 year, fryer oil prices have increased 214%. Chicken wings have increased 389%. Takeout boxes have increased 380%. Now, there's a popular narrative that supply shortages are causing inflation. But I think that narrative is absolutely opposite of what it should be. Inflation causes supply shortages. And I'll talk more about that as we go through today's material. But if prices are increasing fast enough, if you're in a business that has any production time at all, rather than risk building a product or offering, a service over a period of time on which you might lose money, you just simply quit building that product or offering that service. So inflation leads to supply shortages versus the other way around most times. Now, this was a Zero Hedge article. The headline on the article, inflation is imposing real hardships on everyday Americans, $10 toothpaste and $4 gas. Consumer goods companies are raising prices of essential everyday items on Americans as inflation soars to multi-decade highs. The latest to do so is Colgate-Palmolive, an American multinational consumer products company. They announced a new expensive line of toothpaste, according to Reuters. The CEO of Colgate-Palmolive, Noel Wallace, told an industry conference that its new Optic White Pro Series toothpaste would be vital to its ability to raise prices. The new 3-ounce tube, that's small enough so you can take it on the airplane with you, the 3-ounce tube of premium toothpaste will cost a whopping $10. Now, for some context, Statista notes the average price of leading toothpaste, easy for me to say, the average leading but the average price of leading toothpaste brands in the U.S. in 2019 averaged between $4 and $6. The same two-pack costs $10 to $12 now. So that's an increase of 250% to 200%, depending on which part of those price ranges you want to look at. So again, over 200% inflation on those items. That's consistent with what we just looked at as far as fryer oil, chicken wings, and takeout boxes were concerned. Last year, consumer goods companies increased prices due to rising raw material costs, labor shortages, and freight rates. Soaring prices have dented consumer sentiment. Consumer sentiment is at an 11-year low. That's a pretty big development, especially for the U.S. economy, because the U.S. economy is based 70% on consumer consumption. So when consumer sentiment starts to drop, and now it's at an 11-year low, you have to go all the way back to 2011 to find consumer sentiment this low, just coming out of the financial crisis. That will lead at some point to recession. And I believe that that's maybe where we are right now. Some consumers are unfazed by inflation, though lawmakers and consumer advocate groups are probing consumer goods companies for excessively raising prices to fuel profits and return money to shareholders. Now, I talked about this last week. When you start to take a look at what the political response will be, it's almost always the wrong response. The right response is to cease currency creation and raise interest rates so that we have real positive interest rates. That gets inflation under control. That's not what's actually happening. But the political ruling class has to make it look like they're doing something. So U.S. Representative David Cicilline, I think I got that name correct, said, "We're seeing significant price hikes on virtually every item consumers purchase, and he's working on antitrust legislation aimed at bringing down prices." The Federal Trade Commission is investigating Procter & Gamble, Kraft Heinz Company, Kroger, and Walmart for fueling higher prices. Cicilline told Reuters that Colgate is a company touting price hikes, making basic items too costly and paying out more to investors. Well, we talked about this last week, that it's important to understand all the math around corporate finance, and that certainly companies have to make a profit, and raising prices is typically due to inflation. So the White House now is investigating companies for excessive price increases ahead of midterms. Inflation is so troublesome for the administration that President Biden's State of the Union Tuesday addressed the troubling issue. Quote, "Too many families are struggling to keep up with bills. Inflation is robbing them of the gains they might otherwise feel. I get it. That's why my top priority is getting prices under control." So the question is, are price controls next? In the chart here, which will come as no surprise to any of you who own an automobile that's fueled by gasoline, you can see that the wholesale price of gasoline, when you take a look at the chart, that has gone parabolic. So across all items that we have to buy, we are seeing massive inflation. And the article concludes by saying Democratic leaders are in panic mode. Are price controls next? And I talked to you about this on February 12, 2022, just about 4 weeks ago, on this particular broadcast, and said that this would likely be something the politicians might try. So for those of you that weren't on that particular update, I'm going to give you just 4 or 5 slides here as a background. On February 12, I asked if price controls might be imposed again. And I said it wouldn't be surprising, given that the other options to combat inflation are likely not viable. See, price controls history shows us 100% of the time they do not work. They lead to empty store shelves. However, when you look at the other options to combat inflation, things that will work, they're likely not viable. The Fed, as we discussed on February 12, has three choices, and every one of these choices is a bad choice. First, the Fed can cease currency creation, which would quickly lead to a debt-driven deflationary collapse. But we're going to get there anyway. Worldwide debt is at $300 trillion, and the U.S. spending at the federal level comes with a $3 trillion deficit. Now, much of that deficit is being indirectly monetized by the Federal Reserve. So the simple fact is this, and this is just math. In order for the Federal Reserve to cease currency creation, the federal budget will need to be balanced. I'm not hearing anything along those lines being proposed by anyone in Washington. Now, to balance the budget, the numbers are staggering. And this is review for some of you, and I won't spend a lot of time on it. Federal spending would need to be cut across the board by 41%. Once spending was cut 41% to balance the budget, additional cuts would need to be made to close the fiscal gap. The fiscal gap is over $200 trillion. So if we were to balance the budget immediately, we still have a $200 trillion fiscal gap to finance, which if we were able to borrow that money for 30 years at 3%, and incidentally, it's impossible to borrow that much money. China and Japan own a combined total of U.S. debt totaling not much more than 1% of that number. But if we could borrow that money for 30 years at 3%, the resulting annual payment would be more than $10 trillion annually. Federal tax revenues are only $4 trillion. There is not a good solution to this problem. So the only other option is to continue currency creation until there's a currency crisis. At that point, spending will have to be reined in order to restore confidence in the currency. And that's when the deflationary collapse will kick in. So this deflationary collapse, I believe, is unavoidable. The question is, do we have an inflationary crisis leading up to it, or will cooler heads prevail and we simply take our lumps and go through the deflationary period? I don't think that that last option is one that's likely to occur. There's no talk of balancing the federal budget, and there's no way to do that that doesn't lead to a severe deflationary period that I believe could look a lot like the 1930s. So given those facts, it's unlikely that currency creation will cease anytime soon. It doesn't matter what the Fed is saying. We want to look at what the Fed is doing. And now, in light of all the geopolitical tensions taking place around the world, to use a politically correct term, the Fed is saying we need to move a little bit more slowly. So I believe that we may see price controls, and this happened after World War II, which I talked about on the February 12 broadcast. I'm not going to go through it again today, but you can go to retirementlifestyleadvocates.com and go back and look at the February 12 broadcast, and you'll see that after World War II, when price controls were imposed, it was disastrous. Nixon tried the same thing in the 1970s. Nixon did this knowing that price controls didn't work. This is just a little bit from that article. In late July of 1971, about a month before Nixon took the U.S. off the gold exchange standard, Nixon reiterated his opposition to wage and price controls. He called them a scheme to socialize America. Yet a month later, he did a 180. He said, yeah, we need to do this. He imposed the first and only peacetime wage and price controls in U.S. history. Now, the Nixon tapes, personal tape recordings, Nixon taped everything. We can now go back and take a look at why this happened. Nixon, in February of 71, said, here's my concern about the freeze. There's strong support for wage board and wage price controls, particularly from sources like Arthur Burns. And Arthur Burns was a member of the Federal Reserve Board at the time. The difficulty with wage price controls and wage board, as you well know, is they don't work. I'll clean up Nixon's language. They didn't work even at the end of World War II. They will never work in peacetime. Well, I would take it a step further and say they just won't work. He said, I know the reasons you do it. You do it for cosmetic reasons. But Nixon said it's too early for cosmetic reasons. In July, he refers to another program proposed by Treasury Secretary Connally. And a few days later, Connally said, well, you've got a risk when you impose price controls, but there's risk if you don't. Connally said the average person in this country, they don't know the difference. They at least it looks like you mean business, even though you know they're not going to work. And Nixon said, yeah, I guess I will go ahead and do it. Well, now we have the same type of politicians that are saying we need to take action. They're starting to propose legislation that could lead to price controls. But again, that will be disastrous. But political pressure is building. And since the Fed can't take the appropriate action they need to get inflation under control until the federal budget is balanced, there will be probably more talk about this. Now, related to this, we have David Stockman, who was a former budget director in the Reagan administration, admittedly looking at things from a conservative perspective. He talks about how the debt has gone from $1 trillion to $30 trillion in what he calls or describes as a heartbeat. Now, again, if you have questions as we go through the material today, or you've got a comment, please go ahead and type it in the type your comment box. I'm looking at this and we have a really nice size group today. So appreciate you guys getting the word out about the work we're doing here. Stockman starts by saying, how the frog does boil. Recently, the national debt or the public debt crossed the $30 trillion milestone. Yet, neither Wall Street nor Washington took note. Now, he said it did catch our attention, and we want to recall why a young budget director was thumping on the Gipper's chest in the Oval Office photo below. And there is a young Stockman with then President Ronald Reagan. Namely, we were informing him, Stockman informing Reagan, of the unwelcome news that the $846 billion public debt they inherited in December 1980, which had accumulated over 190 years by 39 presidents, was already surging. And there would be no choice but to ask Congress to raise the debt ceiling above the dreaded $1 trillion mark. Now, think about this trajectory, if you can imagine it on a chart for a minute. $846 billion was the public debt after 190 years and 39 presidents. That's about 40 years ago. So it took 190 years to go from 0 to 846 billion, but it's taken only 40 to go from 846 billion to nearly 31 trillion. If you put that on a chart, that chart pattern is parabolic. So Stockman says 41 years later, the public debt stands 36 times greater than the figure he was discussing with Reagan. So he says, here's what we mean by the boiling the frog metaphor. At the time of the photo, no one in Washington or Wall Street thought the public debt could be let run wild with impunity. Everybody knew. In Washington, all the politicians knew, everybody on Wall Street knew, you can't keep doing this. There's going to be unpleasant consequences if you continue to do this. He said that means when Uncle Sam barreled massively into bond pits, it caused an immediate repercussion on the balance of the supply and demand for borrowable funds, thereby driving yields higher and rationing the available supply to borrowers willing to pay the higher price. So in other words, there was this ravenous appetite for U.S. government debt. Back in the day, Stockman says this was called crowding out. It was a very real thing. It was an honest form of financing public debt. But nobody mistook it for a free lunch, knowing that this could not go on forever. Well, things have changed a lot. Stockman did say the congressional Republicans of those days were far from political superheroes. To the contrary, he said he didn't say interest groups would be damned. To the contrary, it was just that the interest groups were lined up on both sides of the debt and spending equation. And he gives an example. The National Farmers Union wanted bigger wheat subsidies, but the Farm Bureau wanted smaller deficits and lower interest rates. Likewise, for every food stamp advocacy lobby, there was a car dealers association demanding less federal borrowing and lower interest rates so they could finance their floor plan more easily. Stated differently, double entry bookkeeping worked under honest public finance. What Stockman's saying here is that all the government debt that was purchased by entities other than a central bank. And it was honest. He said by January of 1981, the yield on the 10-year U.S. Treasury bond stood at 15.6%. Today, it's at about 2%. He said that meant there were a lot of car dealers, farmers, home builders, retailers who had to pay 20% or more, but they decided they didn't want to do that or they couldn't do that. So congressmen didn't have to make like frogs and tell their constituents that federal deficits and debt didn't matter and that they merely needed to ignore the rising temperatures in the debt markets because there would be no adverse downstream repercussions. He said that scheme was totally destroyed over the next 4 decades. And there you see the chart that I asked you to imagine just a few slides ago. You see public debt has literally gone through the roof from 1980 to the present time. Prior to 1970, the Fed's balance sheet stood at about 5% of the public debt. By the early 2000s, however, it was about 10%. That's under the Greenspan money printing policy after 1987. It's now at 26% of the massively bloated public debt. Stockman summarizes it all in one sentence. In a word, the boiling frog is nothing more than massive monetization of the public debt, financial fraud on a biblical scale. So the Fed's balance sheet in 1970 was about 5% of the public debt. It's now 26%, which tells you the Fed is indirectly monetizing this debt. That goes back to the Fed's 3 choices, all of them bad, and that's why I believe currency creation and low interest rates will have to continue, regardless as to what they say. And that is leading to what I believe is probably recession presently. Now, whenever gross domestic product numbers are reported, they're typically revised 3 times. And I think when we go back and this first quarter is probably revised for the 3rd time, we will see that we are likely now in a recession. First quarter GDP forecast is 0% and falling fast. This is from past guest on the RLA radio program, Ms. Shedlock. Ms. said, let's take a look at the latest GDP Now forecast, and more importantly, its current model assumptions versus Mish's assumptions. Now, if you take a look at this particular chart, this shows you that GDP Now is forecasting a 0% economic growth rate. Retail final sales, you see, have been declining with a little bit of a bounce here. And you see that we actually saw GDP decline a little bit. And Mish explains the relationship between retail final sales and economic output. He said the initial estimate for the first quarter of 2021 was 0.9% economic growth. It's now 0%. The initial forecasts have been on the high side, and then they tend to sink as the quarter progresses. So 0% GDP, you've got a 2.5% retail final sales and a negative 2.5% inventory adjustment. So essentially, economic growth is now flat. And it's important to understand that economic growth is now flat in light of the fact that we've got a rapidly devalued currency in which GDP is measured. Mish says the retail final sales number is a very good figure, actually, but it's very early in the quarter, at least as far as data reporting goes. And GDP now estimates have tended to start out high, then sink. And one of the issues that I alluded to earlier is that real personal incomes are falling. They're down for the 8th time in 9 months. So you can see that if you look at real personal disposable income, and you look at this going all the way back to May of 2021, it's the gold colored line on the chart, you see that real income, real personal income has been declining from the prior month every month except July of last year. July of last year is when government stimulus checks appeared in a mailbox. And then if you take a look at the inflation defined by the blue line on the chart, you see income is declining while inflation is rising, which makes it a very precarious situation for consumers. And it's no surprise that in a consumer spending dependent economy like the US is, that we are likely now moving into recession. I look for currency creation to continue. I think we've seen gold and silver now react in that way, although markets never go straight up or straight down. For those of you that are not using the revenue sourcing 2-bucket approach to managing money, if you'd like to talk to someone about how to get metals into your portfolio, feel free to give the office a call. The number here is 866-921-3613. The number here again, 866-921-3613. I will hang out just for a second to see if anybody has any questions. Here we go. So this is someone who said this could be too politically charged for reading aloud. I'm going to read it just a minute here. Certainly, price controls have been done in the past. World War II, they caused big problem once they were lifted, huge inflation. It will only lead to even more catastrophic effect down the road. So at what point do you start to accept the fact that the Great Reset engineers are hoping for worldwide economic ruin to set their final goals into motions? We're now seeing what were once touted as conspiracy theories becoming historical facts. Well, I think that this person who said that, first of all, I think that certainly the World Economic Forum has publicly stated what their agenda is. Their agenda is a great reset. I don't think that's too politically charged. I think that's simply factual. You can go to the World Economic Forum's website and see that their goals are no private property ownership and a great reset. That's how you accomplish those objectives. I don't want to comment really on to what extent, what we're seeing now ties into that. I like to keep my comments to where we are economically speaking. But the final question, is there any way out from this trajectory? I think to this person who posed that question, and there's some interesting thoughts there, and I'd encourage everybody to, do your own research. I think that what you're seeing here are debt levels that are far too high to ever be paid. That was the case in 2007, 2008, when we had the financial crisis. At that time, the Federal Reserve and other central banks around the world started on this path of temporary currency creation. I'll just call it what it is, quantitative easing or currency creation. That temporary program has turned into permanent policy. And back in 2011, I wrote a book called Economic Consequences when I said that is likely what we're going to see happen. So I think the way out is that we have to go through this deflationary time frame, which is ironically a reset in and of itself. The question is, do we go back to a sound money type system after this reset? And it's my hope that that's what happens. And it's my opinion is that is what will happen. History tells us that whenever currency creation occurs to the point that currencies are questioned or destroyed, we always go back to a sound money system. So good comments. Hopefully I at least partially addressed your questions. Here's another question. With this being the first time in world history that all governments are printing fiat currency, what will be the needle that pricks this bubble if there are no consequences to just continuing to print? Well, I think, Jeff, we may be seeing one of those needles emerge now. When you look at geopolitically what's happening, and I write about this in the Portfolio Watch newsletter today. Ironically, the sanctions being imposed against Russia exempt gas and oil. So basically, we are saying to Russia, and Alistair McLeod wrote a great piece on this past week. We're saying to Russia, we're going to punish you, but we want you to still sell us gas and oil. We want you to still take dollars and euros for the gas and oil you're going to sell us. Well, with sanctions imposed, there's no way for Russia to spend those dollars and euros. So they're looking at alternative ways to get payment. So this could ironically be the pin that pops the bubble and moves countries around the world away from the dollar more quickly. India has already set up with Russia rupee ruble-based trading contracts so India can buy their fertilizer and their gas and oil from Russia. Russia can cut their oil and gas production output in half, given that it costs them about $45 a barrel to produce oil, and given that now crude's at about 135, they've got some room there. So now there's talk about, and I don't know if this will be the case or not, but there's talk about now stopping the purchase of Russian oil and Russian gas, which will exacerbate the inflation problem. So I think what you're seeing here is the proverbial rooster is starting to come home to roost, and you're seeing the consequences of loose money policies. So it'll be interesting. I don't know what other word to use to describe it. It'll be interesting to see how all this plays out. But there are a lot of dynamics in place now. There's the geopolitical tensions. There is accelerating inflation with the Fed not taking the action that they would need to get inflation under control because they say of geopolitical tensions, but the math that I walk you through today is still the math. So there will be a pin or multiple pins that pricks the bubble. We will have to see asset prices reset simply because there's too much debt to be paid. It's really that simple. So a couple really good questions there. I'll hang out for just another minute in case there is another question. Putin, another comment. Putin has told Russian companies that they can pay their foreign-owned bondholders in rubles. In the interest of time, it's another great comment, but I think you're seeing the whole currency thing coming to a head. And one of the driving forces essentially behind what might be going on a lot of worldwide geopolitically is related to currencies. Just let me give you the office number one more time. If you would like to call the office and give us a topic you'd like to see discussed on one of these, the number is 866-921-3613. And if we can help in any way, please feel free to give us a call. Great comments and terrific crowd today. So we'll be back again live next week.